And we'll start off with a question of how you see the outlook for the Israeli economy.
Okay, so good evening, and it's very nice to be here again. And let me start with some indicators of where we were just before the war and where we are now, and then we'll move forward. So if we look at the trend of growth, you can actually see that before the war and after COVID, the trend was we were at the level of GDP which was higher than the long-term trend of GDP. So the recovery from COVID was remarkable, and then of course came the decline starting in October, and we'll talk about the recovery then. When we look at the labor market, actually the performance of the labor market is quite remarkable. This is the unemployment. And it's at the lowest point that it has been in 2 decades. Unemployment is remarkably low, and it's not because of low participation, because also the participation rate is high and the employment rate is high. So what's behind the extremely tightness of the labor market? It's partly the economy is recovering, but it's partly also shortage of workers, shortage because of Palestinian workers that are not allowed to work in Israel, and because of foreign workers that many of them left at the beginning of the war. Some of them came back, but there's still shortage, and also because of reservists that are still serving in the army. So we have tight labor market. Actually, when we look more closely at the unemployment level, so when you add to the sort of traditionally defined unemployment, which is at the lowest, as I said, in 20 years, you add to that people that are absent due to economic reasons, and that is mostly around the borders in the north and in the south. And if you add to that people who serve on reserve, the green point here, we're still at a very tight labor market, okay? And that shows up also in wages. Actually, wages in overall wages, which is the blue line, started recovering actually since the beginning of 23, partly because of the tightness of the labor market. There was some decline even in the real wages because the inflation accelerated. So initially, when inflation accelerates, wages, which continue moving up according to previous trend, are eroded in real terms. But then when there is a realization that actually inflation is higher and labor market is tight, we start seeing an acceleration in the growth of nominal wages. And when you look at the business sector, actually real wages, which means adjusted for inflation, have been going up quite rapidly. We don't see the same in the public services, because in the public services, mostly the wages are the result of negotiations between the Histadrut and the government. They lag. In the last 30 years, they lag after the wages in the private sector, but the agreements usually mimic what is happening in the private sector. This time, there is an agreement that was signed, but as part of the adjustment in the fiscal adjustment, now there is going to be a freeze in the wages of the public sector. So what we see is that it hasn't recovered, and it's not expected to recover in the near future because of the wage freeze that has been agreed. Not yet, the budget has not passed yet the Knesset, but that's part of the budget plan. So this is the way the labor market looks, and the bottom line is that wages in the private sector are going up. They're also adding to fueling of inflation. And this is inflation. So before the war, actually, inflation, as you know, went up everywhere, right? In the US, in the OECD, all OECD countries, and also in Israel. In Israel, more modestly than in the rest of the advanced economies. But then inflation started coming down. It started coming down also in Israel, but this deceleration of inflation actually stopped because of the war and the supply constraints that are associated with that. So part of it is related to what we've seen before, the wages and the fact that actually wages are going up because of absence and because of the shortage of labor. And there were also some areas in which there were very specific supply constraints. For example, as you probably all know, flying, the price of traveling abroad, fruits and vegetables that are mostly grown around the borders, an increase in the cost of marine travel, how do you say? Shipping, yeah, thank you. And so there are all kinds of supply constraints that actually led to this upward tick in inflation. I think there is a good reason to expect inflation to start decelerating now because these supply constraints are being eased. We've seen actually some decline in the cost of shipping, of marine shipping. Yeah. I wanted to be very precise. And we've also seen some decline in oil prices, and I think with the easing of supply constraints of labor, we will start seeing also some deceleration in the wages. So right now, inflation is still above the target of the Bank of Israel, but it is expected to ease. Okay. In terms of activity, this is a sort of daily indicator of consumption. These are credit card purchases. The data is coming daily, so you can actually see the trends very quickly. And what actually here, the blue line is in real terms, so it's corrected for inflation, and the orange line is not in nominal terms. What you see is the very sharp decline initial in October, but then you see a very quick recovery thereafter. In nominal terms, full recovery, but still inflation is higher. So when you look at in real terms, it's still lower than the trend. But when you look at the level of credit card spending, it's about 5% higher than it was before the war. So consumption has recovered. It's not booming, but it definitely has recovered. Exchange rate. So the exchange rate, actually, I have to say that if somebody would have told me that we would have a 14 months, 15 months now, long war, and that the exchange rate would be roughly where it was before the war, I would be very surprised. But the strength of the shekel is very surprising. It actually, if I would have shown here a much longer term graph, what you would see is that in the short run, the shekel-dollar exchange rate was very, very closely correlated to the S&P 500. And the reason for that, and that's beyond all the fundamentals that are behind the strengthening of the shekel that I'll mention in a minute. But the short-term effect of the trend in the S&P is related to the fact that institutional investors invest abroad, but when the valuations of the stock markets in the US go up, they have to reduce their exposure to foreign exchange, okay? So that means that they're actually buying No, selling for.
Shekel.
Yeah, buying shekel, yeah. And that actually offsets the higher exposure that results from investing abroad. And therefore, that is what explains the short-term strong correlation between the S&P and the shekel. Now, this correlation was to a large extent broken in the beginning of 2023 when the judicial reform was announced and there was a lot of noise in the market. And so we've seen actually a weakening of the shekel after that and a breakdown of this correlation. Then with the breaking of the war, there was additional strong devaluation of the shekel. It was halted not long after that, I think with the aid of the announcement by the Bank of Israel that it is willing to support the shekel. It said that they are willing to sell up to 30 billion shekels dollars in order to avoid a very sharp depreciation. They also had additional $15 billion that they were willing to do swaps for. So I think that eased basically the fears in the market. And then what we've seen since then is more or less stable shekel dollar exchange rate. If you would look at the old correlation between the shekel and the S&P, what you would have seen that the shekel should have been much stronger. So although for us, I didn't look today, but 3.6 seems very strong shekel. But if it would have followed the correlation with S&P, would have been much closer to somewhere between 3.2 and 3.3. So it looks very strong, but there are forces that make it strong, including this short-term correlation, beyond the fundamentals of current account surplus and surplus in terms of assets in foreign exchange and still attractive high-tech sector that again attracts now foreign investors. So